Hello, welcome to today's tutorial. I'm your tutor, Senior Hannington, and I'm delighted to have you here. We will be tackling a comprehensive question from a past CPA financial reporting paper. This is a compulsory question focusing on group accounts carrying a substantial 40 marks. It requires the preparation of consolidated financial statements. That is the statement of profit or loss and the statement of financial position. The question also includes a section on computing and interpreting key financial ratios. Read the question carefully before you start any calculation. Read the question carefully. You should be having this on your table. This is from June 2022. June 2022. So you should be having this on your table. Then read the question carefully before you start any calculation. You have to understand the relationship between the parent and the subsidiary companies. Note the dates of acquisition and any intra-group transactions. So have a read. Read the question. Read the question. This is our acquisition date. That's the acquisition date. This is our parent, ATL. It acquired 75% of the shares of Ross Hotel Limited. So now we have the parent as well as the subsidiary. This is your purchase consideration, 15 billions. That's the purchase consideration. The reporting date is 31st December 2021. So from 1st April 2021 to 31st December 2021, we have a post-acquisition period of 9 months. So this is the statement of financial position, as you can see, for the two companies. ATL is the parent, then RHL is your subsidiary company. Have a read of the question. You have the statement of profit or loss and other comprehensive income for the year ended 31st December 2021. Then we also have some additional information on the date of acquisition. The retained earnings are these. These earnings, we use them when it comes to the computation of goodwill. Don't forget, there is a fair value adjustment. One of the buildings of the subsidiary had a fair value which was higher than the book value by shillings 2.5 billion. So there is a fair value adjustment. The buildings are depreciated on a straight line basis over their useful lives. So there will be a post-acquisition movement. You have to calculate depreciation there. The fair value of NCI in RHL at the time of acquisition was 3.5 billion. So they have given you the fair value of NCI as 3.5 billion. It's the group's policy to value the NCI at fair value. So First things first, what you'll do, let us look at the requirements. The question has 3 parts. There is the part of the statement of profit or loss, the part of the statement of financial position, and then the computation of ratios, and then giving a commentary. So this will be my part A, Roman 1. Part A, Roman 1, and I'll put my heading. This is a group statement of profit or loss. And other comprehensive income. The group statement of profit or loss, another comprehensive income for the year ended 31st December 2021. So that's my heading, that's my first page, and that first page I'll use it for the statement of profit or loss. So that will be my page for the statement of profit or loss. The amounts are in shillings, millions. You've seen that. So let's maintain the millions still. Okay, so this is my P&L, so I'll put that here. Then we also need the statement of this is A. This is my second page, A Roman 2. We can call this group. This is ATL and group. ATL and group. ATL and group. ATL and group. So this is my second page, ATL group, statement of financial position. As at, so I'll use this for statement of financial position. That is for the statement of financial position, where we have to show the assets, the liabilities, equity of the group. I'm going to use one column, but you can still use 2 columns. So that's it. That's it. That's our page for the statement of financial position. Then I also get a page for part B. Page for part B, you can get one for part B. You can do it here. This is part B. This is part B. Okay, so I think we can start. Then you also need a page for your workings. This is my page for the workings. My workings page. I'll use this for the workings. And I'll start with the very first working. That my workings. Working 1 is going to be about the group structure. We have been told we have a parent as well as a subsidiary. The parent is ATL. So we have ATL. This is my working 1. Group structure. It's my working 1 group structure. So I have ATL, which is the parent company. Then we have RHL, that is the subsidiary. The acquisition was on acquisition date. That's 1st April 2021. And I've told you we have a 9 out of 12 post acquisition period. The percentage acquired, that's 75%. The cost is 15 billion. 15 billions. Of course, our NCI is 25%. That is your simple group structure. So this is the parent ATL, and then RHL is the subsidiary. My working 2, I'll come up with the goodwill. That's working 2. Goodwill working. Let me do it here. Goodwill. So that will be my working 2. Goodwill. That's working 2. Goodwill. 2 goodwill. You should know how to compute goodwill, because this is expected when it comes to questions of consolidations. You're likely to compute goodwill always. So you should know how to compute goodwill according to IFRS 3 business combinations. Okay, so to compute goodwill, you need the cost of the investment. Cost of the investment. The cost of investment, it has been given to you. That's 15 billions, and there is no any other adjustment to make. So that is your cost of the investment. It's 15 billions. You get the fair value of NCI. That's at acquisition. Fair value of NCI at acquisition. It has been given in the question. That's in the additional note 1. Fair value of NCI at the date of acquisition is 3.5 billion. So you bring the 3.5 billions. 3.5 billions. So the aggregate of this is how much? Is 18.5 billions. Then you have to less the fair value of identifiable fair value of identifiable net assets of the subsidiary. That's at the date of acquisition. And these are represented by what? By share capital. A share capital. That share capital of the subsidiary is 5 billions. Check the statement of financial position. Share capital of the subsidiary is 5 billion. That share capital is assumed to be the same share capital as at the date of acquisition. The sub as share premium. It has share premium. How much is the share premium? That's 2,500. Share premium 2,500. Then we have to get the pre-earnings. The pre-earnings. The pre-earnings, that's additional note 1. The pre-earnings, that is 5.85. 5.85 billions. Those are the pre-earnings. Pre-retained earnings. Then there is a fair value adjustment. We have to increase these net assets because they were understated. One of the items of PPE was understated. So there is a fair value adjustment. That's a building that it had a fair value of 2.5 billion higher than its book value. So this makes your net assets figure. Which gives us 15,850 as the fair value of the identifiable net assets. So we have to less this fair value of the identifiable net assets from the aggregate up there. Then what we come up with is our goodwill, which is 2.65 billions. No impairment. I've not seen the examiner talking about impairment of goodwill, so that will still be our goodwill at acquisition date stroke reporting date, or goodwill at reporting date. If there is impairment, then you have to remove the impairment loss on the goodwill, but we don't have impairment. So note 1, the second paragraph, this is we have utilized this well as this. However, we have a fair value adjustment. That's the building. I'll do a working, that will be my working 3, about the post-acquisition changes on that building. So this is working 3, fair value adjustment. Brackets, it's the building. So what was its value at acquisition date? Acquisition. Then I have to get the movement. The movement, that's the depreciation. It can be amortization if it's an intangible asset. Then at reporting date. At the reporting date. So these amounts are in shillings, millions. So we have our buildings. If you have some other items, then you can list them. But this is the building At acquisition, the value is 2.5, but then we have to get its movement. Movement, that is the depreciation. We have been told that it has a remaining useful life of 10 years at the time of acquisition, higher than its book value. The buildings are depreciated on a straight line basis. So we have to depreciate. This is to 500. We divide by 10 years. But remember, the post-acquisition period is 9 months. So I have to multiply by 9 out of 12. And this gives us 187.5. 187.5. So at the reporting date, it means that this building will be having a fair value of carrying amount of 2.312. Okay, that is 2,312,500,000. That would be the carrying amount of that building. Don't forget that this will be added to the PPE. Added to the group PPE. And then this movement, this is depreciation. You've been told that depreciation will be charged to administrative expenses. That's note 6 of the question. So this will be added to the administrative expenses. Don't forget. Added to the admin costs or expenses. So that's it for the fair value adjustment. Remember, you have to show your workings. For a 40-mark question, clear and well-structured workings are essential. Even if your final answer is incorrect, you can still earn marks for the correct workings. Okay, we continue. RHL manufactures shoes which are sold mainly to the tourists. On 10th November 2021, RHL sold shoes to ATL for sharing 600 million at a markup of 20%. 70% of these shoes remain unsold at the end of the year. So this is going to be my working for. This will be my working for. So this is intra. Intra-group trading. Remember, the intra-group trading we have to eliminate. So eliminate these are common adjustments. Eliminate intra-group sales and purchases of sharing 600M, i.e. we are to debit group revenue that is by sharing 600M, and then we have to credit the group cost of sales by sharing 600M. Don't forget to calculate the unrealized profit, PAP, provision for unrealized profit. Provision for the unrealized profit. You have been given a markup of 20%, so that will be 20 over 120. I want to get the profit. That sales value includes a profit element. So 20 out of 120, then times 600 M. That's the sales value of the goods. But we have been told that 70% of the goods remained unsold. And this gives us 70 M. That 70 M has to be eliminated on consolidation. Don't forget. Eliminate the 70 M. Consolidation. What do? We have to debit the cost of sales by sharing 70 M, and then we have to credit inventory. Sharing 70 M. Remember, NCI is measured at fair value. So as you're coming up with the working for NCI, they are also affected by this unrealized profit. We have to find out who is selling. This is RHL. RHL is your sub company, so NCI will be affected since it's measured at fair value. So this note, we have also used that. We have utilized it. In other words, we have seen the adjustments to make when it comes to note 2. It's an intra-group trading. So eliminate the intra-group sale and revenue. Then also eliminate the unrealized profit on the goods that remained unsold at the end of the year. It's the group policy to carry out impairment tests on its property, plant and equipment at each reporting date. On 31st December 2021, the results of the impairment tests showed that one piece of equipment belonging to RHL had a carrying amount and a value in use of shillings 6.2 billion and 5.2 billion respectively. The fair value less cost to sell of the same equipment was shillings 5.7. The results of the impairment review were not accounted for in the above financial statements. When you see they were not accounted for in the above financial statements, then you must account for them. Okay, you must. So this is going to be our working 5. This was working 4 for the intra-group trading. Now let me take you to working 5. Do it here. Working 5. Can call this impairment. Impairment on PPE. Impairment on PPE. Impairment on PPE. Remember, according to IS 36, we cannot carry an asset at an amount which is greater than its recoverable amount. So what's the carrying amount? The carrying amount of this PPE is 6.2. That's the carrying amount. Then you've been given the fair value. Fair value less disposal costs. Fair value is how much? The fair value is 5.7 billions. That's 5.7 billions. Then you also have the value in use. Also have the value in use. How much is the value in use? The value in use is 5.2. 5.2. That's our value in use. So impairment arises when the recoverable amount of an asset is less than the carrying amount. The carrying amount is 6.2, but then we have to determine our recoverable amount. Recoverable amount. Recoverable amount is the higher, don't forget, the higher of value in use and the fair value less costs to sell. Okay, the high of the fair value, less cost to sell, and the value in use. Higher of the fair value, less costs to sell, and the value in what? And the value in use. Now in this case, what will be our recoverable amount? Our recoverable amount will be, it will be what? Our recoverable amount will be 5.7, because 5.7 is higher than the value in use of 5.2. Therefore, there is impairment here. There is an impairment loss. There is an impairment loss. Impairment. Impairment loss. The impairment loss, that's the carrying amount, which is 6.2 minus the recoverable amount of 5.7. We get an impairment loss of 500,000. So this is our impairment loss. Impairment loss is an expense, so the required adjustment, required consolidation adjustment, required consolidation adjustment. What we should do, should debit administration expenses, because we have been told that impairment, depreciation, we charge them to the impairment, we charge them to the administrative expenses. Then we also have to credit the PPE of the group. We have to reduce the carrying amount of the PPE by 500M. So that's the adjustment to make when it comes to the impairment note. We move to the next. So this is note 4, and we see this is note 3. So now I want to take you to the next note. On 1st July 2021, ATL acquired, ATL is the parent, don't forget, acquired newly developed structures at a camping site from one of its property developers in Kidepo National Park at a cost of shillings 4.2 billion. The site structures are expected to be operational for a period of 10 years and thereafter be demolished. Currently, there is neither environmental law nor company environment policy that requires restoration of areas where structures are demolished in the parks. However, as a matter of practice, ATL restores areas within game parks where its structures are demolished. As a matter of practice. So there is a constructive obligation here. ATL estimated that it would cost shillings 2 billion to restore the area after demolition of the structures in the camp. ATL's cost of capital is 10%. and it depreciates structures at the camping site on a straight line basis over their useful lives. The implication of the restoration of the area where the structures were purchased has not been accounted for in the above financial statements. So what you have to do, you have to account for the implication of the restoration of the area. You have to account for that. So according to IAS 16, the initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located, those costs should be included in the cost of an item of PPE. So the entity has an obligation, okay? The entity has an obligation. So these costs have to be capitalized. So we have to recognize a provision, and the provision amount will be added to the cost, the initial cost of these structures. So let me take you to my workings. This is going to be working 6. That will be working 6. This is working 6, provision for restructuring. This is shillings how much? Okay, we have 2 billion. The restoration will, this is the restoration, not restructuring. Provision for restoration costs. Provision for restoration costs. We have been told that it is shillings 2 billions. At end of year 10, at end of year 10. And I've told you that according to IAS 16, these costs should be capitalized, okay? The estimate of the costs of restoration and removing the site on which the asset is located should be capitalized. So I'll say that the group, this is our, okay, the group, this is the parent, our, it's ATL, so that the group has a constructive obligation for the initial estimate of the costs of dismantling. Okay? Of the cost of dismantling and removing the item and restoring a site. Okay, so now how do we measure this provision? Time value of money is material, so we have to discount. We have to discount and measure this provision at its present value. So the PV of the restoration costs will equal to, this is 2 billions 2 billions. Okay, let me use millions because my amounts are in millions. I'll put this 2000 times 1 over 1 plus 0.1 because that was the rate, then power 10, and this gives us how much? My calculator gives me 771.067 M. That's the PV of the restoration costs. So what are the adjustments required? We are to debit PPE by sharing 771.067 M, and then we have to credit provisions for the restoration costs. That is 771.067 M. That's the adjustment required. But we have to compute depreciation for these costs. Since they have been capitalized, you will have to compute depreciation also. Remember, nothing has been recorded, nothing has been accounted for, so there will also be depreciation expense. Depreciation costs, this is for the 60 months. You're going to depreciate this. So 771.67 M over 10 years. But then you have to multiply by 6 out of 12. Why? Because these structures were acquired on 1st July 2021 and you're reporting on 31st December 2021. So we have to compute depreciation for a period of around 6 out of 12 months. And this gives you how much? This gives you 38.55 M. That is your depreciation. How is it going to be recorded? We have to give our journal entry. Journal entry to record this depreciation expense. So what we are going to do, you'll debit administration costs, that's by how much? By 38.55 M. Then you have to go and credit, that's accumulated depreciation by 38.55 M. So that's the adjustment on the that's the depreciation adjustment. Then maybe the other thing you have to look at when it comes to this provision, now because time value of money is material, we have to account for the unwinding of the discount. So we need to find out the finance cost on we have to find out the finance cost on this present amount, the present value. So unwinding the discount, that PV, we have to increase it by the finance cost each year. So this is our finance cost. So it's 10% times the present value. How much is our present value of this cost? That is 771.067 times 771.067, but of course you multiply by 6 out of 12. This gives us how much? My calculator gives me 38.55M. That's the discount, the unwinding of the discount. In other words, the finance cost on that PV. 067. Yeah, 38.55. So what will be the entries to record this? Journal entries, you're going to debit the finance costs by 38.5, and then you credit the provision for restoration costs. You credit the provision for restoration costs by the same amount, 38.55. So that's your working, your fifth working. Okay, so this is something we have worked on. We move. So the group is policy to value intangible assets at fair value. On 31st December 2021, the intangible assets were revalued, and their value had fallen by 60%. The balance of the revaluation reserve account of ATL is attributed to the revaluation of intangible assets. So let us check. There is a balance on the revaluation reserves account of the parent. This, okay, 1,500. This is attributed to intangible assets. Okay, it's attributed to intangible assets. The results of the revaluation conducted on 31st December 2021 have not been accounted for in the above financial statements. So you have to account for these. You have to account for the revaluation. Okay, so this was our working 6. This was 4. This was 2, 3. Oh, this is 4. Oh, this is 3, then 4, 5, 6. Okay, this is so according to my workings, this should be working this should be working 6. Then okay, so I'm moving to working 7. So working 7, this is revaluation. Of intangible assets. So you have to apply the revaluation model under IS 38. So you have the carrying amount Our carrying amount has been given as how much? The carrying amount is carrying amount is how much? Oh, on 31st December, the intangible assets were revalued and their value had fallen by 60%. So first check and see the intangible assets value. It is 3.5. The carrying amount at the end of the year is 3.5. Remember, the effects of revaluation have not been accounted for. So we have a 3.5. Then revalued amount. We have been told that its value fallen by 60%. Its value fallen by 60%. So what is 60% of 3.5? This is 1.4. So you see the carrying amount is 3.5, the revalued amount is 1.4. So there is a loss. There is a loss of 2,100 millions. There is a loss of 2,100 millions. So we have to record this. So what will be the adjustment required? The adjustment required. So when it comes to the adjustment required, we have to debit. This is the revaluation loss. According to IAS 38, we should take this to the P&L. It's an expense, but remember, we have a revaluation reserve attributed to these intangible assets. So we have to first of all reverse. So we have to debit revaluation reserves. How much was the balance on the revaluation reserves account? There is a balance of 1,500. Now these same intangible assets have been revalued and there is a loss. So we have to write off the 1.5 which exists in the accounts. So we have to first write off the 1.5 billion. Then we have to debit the balance to the administrative expenses. Remember, the impairment loss is 2.1. It's 1.5. So there is a balance of around 600 M. Then we have to credit the intangible assets. By shillings 2.1 M. That's the adjustment we have to make. So I think we have this is the note about revaluation changes, impairment, depreciation are charged to administrative expenses. Revenues and costs accrue evenly throughout the year. So I think I can start on my statements very fast. Statement of profit or loss. Let's first look at the statement of profit or loss. So you go to your page, you have your workings as per the additional information. Group statement of profit or loss. Let's do this chap. And then we see. So what you have to do, you look at your statement and then we enter the items one by one. We have revenue. So we have revenue. What's the revenue for the parent, that's 25,000, but then we have to add that of the subsidiary. Subsidiary has 13,000, but remember it is an acquisition during the year, so you have to multiply by 9 out of 12, and then don't forget to eliminate the intra group revenue. That is working number 4. There is a 600 M to eliminate from, okay, working 4. You have to clearly show your workings. So this is 25M plus 13 times 9 out of 12, then minus 600, and that gives us 34,150. That's my revenue for the group. Okay, then you move to the cost of sales. Cost of sales. The parent is 17,000. Then plus the subsidiary 6.7. I'll add the unrealized profit 6.7, but times 9, don't forget time apportion, times 9 out of 12. Then I'll add the 70M, that's working 4. Then I'll minus the 600M. That's working 4. It's working 4. So compute how much do we get. So I get my calculator gives me 21,495 as the cost of sales figure. So we can get our gross profit, and our gross profit is how much? Our gross profit is 12,655. Next is distribution costs. Distribution costs. The parent is how much? To 500. Then plus the sub. The sub is 1,500 times 9 out of 12. No adjustment to make. So this is 2,500 plus 1,500, but times 9 out of 12, which gives us 3,625. That's the distribution costs. Then administration costs. Now for the administration costs, I think it's better we make a working for them, because we have a lot of adjustments to make. This was working 7. I can make that to be my working 8. Let's make it working 8. Distribution administration costs. Let's make it working 8. This was 5, working 8. This administration costs. Administration costs. So I'll say ATL is the parent. That's 3,000. Then RHL, the sub, that's 9 out of 12 times 1,800. Is it? Yes. So this gives us 9 out of 12 times 1,800. That gives us 1,350. Then there is a depreciation. There is a depreciation on the building. That's the fair value movement. That was working 3, I think. Just to confirm. That is 187.5. 187.5. Then we have the impairment loss. Impairment loss. That's on the intangible assets. That's working 7. Impairment loss. Is it 500? No. It's 600M. We take 600M, not 500. Then there is also something to add. What else? There is also the impairment loss on PPE. 600 is, this is a revaluation loss. Okay, you can call it revaluation loss stroke the impairment, but let us call it a revaluation loss. That is on intangible assets. On intangible assets. Impairment loss on the intangibles. Then there is that's revaluation loss. There is also impairment loss on PPE. This is working number. It's working number 5. Working 5. Impairment on the PPE, and this is how much. This is a 500. And we've said that debit are administrative expenses. Then there is also depreciation on the structures, on the restoration costs. Depreciation. Remember, the costs were capitalized on the restoration costs, capitalized. That's working what? That's working 6. Yeah, that's working 6. It's working 6. Depreciation. This depreciation is 38.55. I think that's it all. So you can add You see how much we have. Makes more sense to do it from here because of the space the other side. Okay, let me round off, reduce the decimal places. So we have 5676. So this is 5676. 76. So that's our distribution costs, 5676. Okay, those are the distribution costs. Then I see we have investment incomes, investment income, and under the investment income I see we only have that of the parent, which is 2000. Then from the investment income, then you have the finance costs. The finance costs. Parent is 1500. Then plus the subsidiary 600. By 600 we have to time apportion it, so that is times 9 out of 12. Then we have to add the unwinding of the discount on the provision. That is working 6. There is a 38.55. 38.55. Check my working 6. Is it working 6 really? Yep, working 6. So this will equal to 1500 plus 600 times 9 out of 12, then plus 38.55. Oh, 38.55, which gives us 1989. I think there is a rounding off to 0 decimal places. Okay, so we can get our profits, our profit before tax. We can get a profit before tax. So that's my profit before tax, 3,365 million. Then we can bring the tax expense. The tax expense. The parent is 700. Then plus the sub. The sub we have 200. That time was 9 over 12. We have our 700 plus a 200, but times 9 out of 12. This gives us 850. So we can get our profits for the year. Profit for the year, which is this. That's our profit for the year. Then since it's a statement of profit or loss and other comprehensive income, you will say other comprehensive income. Other comprehensive income. And other comprehensive income, of course, according to our journal entries, there is a revaluation loss, but this loss is reversing a previous revaluation surplus. Reversing a previous revaluation surplus. So this surplus is going to be recognized. This loss, part of the loss, is going to be recognized under other comprehensive income. Why? Because it reduces the accumulated revaluation reserves in equity, as we have seen, because there was a 1,500. So this decrease is going to be recognized in OCI. Okay, this decrease of 1,500 is going to appear in the OCI. So I'll say revaluation loss. However, if it was a first time revaluation, then it would go to the P&L up there. But this is a revaluation loss which is attributed to intangible assets, and these intangible assets have a revaluation surplus accumulated in equity. So there is a reversal of revaluation surpluses, so this loss will be taken to the OCI. Then you can get total comprehensive income. Comprehensive income, which will be this, which will be this minus this, giving us that. So that is your total comprehensive income. The profits for the year have to be attributed, so let us attribute profit for the year attributed to the owners of ATL, that's our parent, and then to the non-controlling interest. Don't forget this. Whenever it's a P&L and the sub is not 100% who owned, then you need to attribute the profits for there. So I'll do this from in working. It's my last working. My last working is working 8. Okay, let's make it working 9. Let me show you how to get the profits share for the NCI. Okay, this is working 9. So NCI, the NCI share in post acquisition profits. NCI's share is only in the profits of the sub, don't forget. So how much are those profits? So we have the post acquisition profits of RHL, and that is 9 out of 12 times those profits. The profits are how much? Profit for the year of the subsidiary. That's 2,200. So 9 out of 12 times 200. That gives us 1,650. Those are the post-acquisition profits. But of course, there are some adjustments to make on these profits. What are the adjustments? First of all, there is a fair value adjustment movement. That's the depreciation. You can call the depreciation. That is working 3. And that depreciation is how much? It's 187.5. Okay, they are rounding off to 188. We have a PAP, that is unrealized profit, because the subsidiary sold. That's working 4. So mean that NCI is going to be affected. That's a 70. So you first adjust the profits, that's 70. Then there is impairment loss, RHL. The sub has an item of PPE which suffered impairment, so adjust those profits still by the impairment loss on PPE. That impairment was 500, reduces the profits. So meaning that we have a post acquisition profit figure adjusted. Okay, we have a post acquisition figure adjusted, which is 893. So the NCI has 20%. So 20, is it 20%? It's 25%, I think. Just confirm. Let me look at my group structure. 25%. So 25% times this gives you 223. That's my NCI share in the post-acquisition profits of the sub. That's what we have. So it's what I'll bring here. That's 223. Remember, the total profit for the year is this. So what will be the owners of the parent's share? For them, they will take the balance, which is 2292. That will go to the owners of the parent, owners of ATL. Then you can also attribute the total comprehensive income. Total comprehensive income. Attributed. Total comprehensive income for the year. Attributed to owners of ATL, and then to the non-controlling interest. The non-controlling interest. Now, since the NCI since the subsidiary has no other comprehensive income, because this revaluation loss is arising from intangible assets of the parent, as per the note. So meaning that the NCI share in the total comprehensive income will still be the same as their share in profits for the year, because the NCI has no other comprehensive income. Remember, NCI, its share is in the profits for the year of the subsidiary, or the total comprehensive income for the year of the subsidiary, but the subsidiary has no any other comprehensive income. So meaning that the share of the NCI in the total comprehensive income is still 223. So comprehensive income is this, total comprehensive income, meaning that the balance will go to the owners of the parent, and they will take 792. They will take 792. So that is the consolidated statement of profit or loss. It was a media sub, so you had to time a portion. So always look at the dates of acquisition. Where you have a question, please feel free to ask. That is my statement of profit or loss, and it carried around 14 marks. Let's do the consolidated statement of financial position very fast. So what are the items on the face of our statements of financial position? PPE. So non-current assets first. Non-current assets. Under the non-current assets, the parent is 18,500. That is property, plant and equipment. Parent, how much do we have? We have 18,500 plus the subsidiary. Subsidiary has how much? 20,000 plus 20,000. In the balance sheet, we don't time our portion, please. Then you have to add the fair value adjustment. You have to add the fair value adjustment. There was an item of PPE, the building, and I've told that at the reporting date we are going to add the 231 2.5 on the PPE, on the group PPE. So plus plus 2312.5 that's working 3. Need to, it's working 3. Then what else do we have? We add that. Then we have to add the restoration costs capitalized. That is 771.067. That was working what? That was working that's working 6. Okay, this was supposed to be working 5, but let's maintain the 6. I think I skipped working. This is working 6. Oh, I have 5 somewhere. Then we have to minus the impairment of 500. That's working what? Impairment loss. Impairment is working 5. Okay, working 5. We have working 5 impairment. This is working 5. Okay, so 18,500 plus 20 plus 2312.5. This is 0.5. This 9 is from where? Then plus the 1.067. then minus the 500, excuse me, 41. Oh, there is something we are forgetting. We also have to minus the depreciation on the restoration costs that have been capitalized. We have to minus, it was 38.55 from the same working 6. Yeah, we have to minus that. If you see that you don't have space, then you can do a working for that. So minus 38.55, which gives us this. Okay, so that's property, plant and equipment. Then the intangible assets. Intangible assets. The parent has intangible assets of 3,500, but there is an impairment loss. The impairment loss was 2,100. That is from working number what? Impairment loss. Working 7. Tangible assets. No, it's not working 7. Where is working 7? I think it's the other side. Oh, this is working 7. There is an impairment of 200 from working 7. So we net off that impairment. Working 7. The sub has no intangible assets. So this gives us the 1,400. Bring your goodwill. That's from working 2, I guess. Our goodwill is how much? Our goodwill is 265010. That's your goodwill. The investment in RHL, the 15 billions, that's the cost of investment. We eliminate it. We eliminate that on consolidation. So this plus this plus this gives us a total non-current assets figure of that. We can move to the current assets. And under the current assets we have inventory. The parent has 3K, that is 3,000. Then the sub has 2,000. Then we have to minus the provision for unrealized profit, that is 70, from working what? From working 4. Working 4. 2,000 plus 3,000 minus 70, that gives us for 930. Then you have other current assets. Other current assets. The parent has to 600. Then the sub has 500. You add them. That gives you 3,100. This is 5,000, sorry. Excuse me, this is 5,000. Is it? Wow. So this gives us 7,600. So those are the only current assets which we have. And when you add these, they give you that. So we can get our total assets figure, which is the current plus the non-current, giving us 57625. So that's my total assets. So we move to the section of equity and liabilities. So I'll start with equity. Equity and reserves. Equity and reserves. So here we have the ordinary shares. We take that of the parent company, that's 10,000. Share premium parent, share premium parent, that's how much? It's 5,000. Then retained earnings. Retained earnings. When it comes to the retained earnings, this time around you don't need comprehensive working. You have the retained profits as at 1st Jan 2021 of the group of the parent, that is 6,200. You have this 6,200. So if you have that 6,200, it's what you're going to bring here, 6,200. Then plus the share in the profits for the year. The owners of the parent, their share in the profits for the year is 2292. So plus 2292. Because now you have a profit or loss statement, and you already know what goes to the parent's shareholders in terms of the profits for the year. So just add that to the retained earnings at the start. There are no dividend payments. So 6,200 plus 2290. However, if it was a statement of a financial position question, then you find that you have to make a working for retained earnings, then you get your group retained earnings. Revaluation reserves. Revaluation reserves. Remember, the loss reversed that surplus which exists. So here I would just put a 0 because it's 1,500 minus a 1,500 from working. From working what? From working 7. That's debit revaluation reserves by 1,500. So that's working 7. That's why we end up with a 0. So we can add this equity. This gives me 23,492. And this is equity attributable to owners of ATL. Equity attribute the owners of ATL. You can bring your non-controlling interest. Non-controlling interest. To get your NCI at their end, you have the fair value of NCI at acquisition, which was given as how much? Which was given as 3.5 billion. So I'll just get the 3.5 billion plus their share in the post-acquisition profits. Their share is 223. plus a 223 plus a 223, and that gives us how much? 3500 plus a 223, that is 3723. So I can get my total equity, which is this plus this. That's total equity. Total equity. From total equity, then we can move to the liabilities section. We can move to the liabilities. So non-current liabilities, and under here we have the long-term debt. Parent is how much? 15,000, and the subsidiary is 7,500. No adjustments to make on that. 7,500. This gives you how much? That gives you 22,500. Then there is a provision. This is long term provision for restoration costs. The amount is 771.067. This is from working. It's from working 6. Don't forget to name your workings. Working 6. Then still plus a finance cost of 38.55, unwinding of the discount. Same working. This is 771.067 plus 38, which gives you 810. Gives us 810. This is non-current liabilities. Then the current liabilities. The current liabilities to 600 and for 500. To 600 plus for 500. That's how much? To 600 plus 500. That's 7,700. So now we can get our total. We can get our total. We can get our total. So I'll get a total equity plus this total non-current liabilities, then plus the current liabilities, gives us 57,625. 57,625. So this is our total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So that's the statement of financial position, and then the statement of profit or loss for this question. Question practice is very, very key. Practice makes perfect. So these questions of group accounts can be complex. So the more you practice, the more confident you will become. Time management is very, very key. given the weight of this question, you have to allocate your time wisely, because you have to ensure that you also have enough time for the rest of the questions in the paper. So you have to practice, and time management is very, very key. Now there is a part for computing ratios, and then giving a commentary on the different ratios. Let's check and see. It's time enough. These are 6 marks. Acid test ratio, interest cover ratio, then return on capital employed, then gearing ratio, debt and the equity. Okay, so we have to compute these ratios. We have to compute the ratios. So part B, so we are going to compute the ratio. This is ATL group. Then we have similar sized company. Similar sized company. Then we also have industry average. We have the industry average. The first ratio is acid test ratio. Acid test ratio is the same as the quick test ratio. So this is 1 acid test ratio. How would you compute the acid test ratio? You have to get your current Your current assets. Sorry. You have to get your current assets. By the current assets, you have to minus the inventory. You have to minus the inventory. So what are the current assets of this group? Current assets of the group, excluding inventory, that's going to be 7,600. So this will be 7,600 over the current liabilities. Current liabilities are what? We have current liabilities for the group. That's 7,100. And that gives us what? 7,600 by 7,100. That gives us 1.07. 1.07, that's the ratio which we have. In fact, it's 1 to 1.07. Then for the similar sized company, it has 1 to 1.5, 1 to 1.5, then 1 to 1.2, 1 to 1.2, is it 2.5? 2, yes, okay. The next is interest cover. interest cover. When it comes to interest cover, we are looking at the number of times the company can meet its interest payments using the profits. So here we have to get our profits before tax and interest. We have to get our profits before tax and interest. Profits before tax and interest. Profits before interest and tax. Profits before interest and tax. Profits before interest and tax, then over the interest. So my profit before interest and tax for the group, this is before, then I have to add the interest. This is 3365. Okay, so I have to get 3365, then plus the finance costs 1989, then over 1989. This gives us what? 3365 plus. This gives me 2.69. 2.69. Similar sized company, that's 2.5. It's 2.5. Then industry average 3. Industry average, we have a 3. Okay. Then what's the next T ratio? Return on capital employed. ROS. ROS equals to the profits before tax and interest over the capital employed times 100. So your profits before interest and tax, that is 3365 plus 1989, then over the capital employed. Capital employed, that is going to be the total assets, which you have as 57625. Minus the current liabilities. 57625 minus the current liabilities of 7100. 7100. And this gives us what? This gives us 10.59. 10.59, or you can make it 10.6. Similar sized 25%. Then industry average is 20. Industry average is 20%. Last ratio, this is gearing ratio, debt and equity. Okay, this is number 4. Gearing ratio, debt and equity. So this will equal to debt over debt plus equity, then times 100, since it's expressed as a percentage. So what's our debt? Go and look at the non-current liabilities. Non-current liabilities, we have 23310. The long-term debts, 23310. 23310. Then over debt and equity. Over debt and equity. Equity is 27 to 15. 27 to 15. Then times 100. So this gives us what percentage? 23310 divided by 10 plus. This gives us 46. So that's 46.13%. Similar sized 40. Similar sized it is 40. Then industry average is 50. So you are required to assess the performance of the group during the year end 31st December 2021, given the performance indicators of the similar size and the industry average are these 6 marks. So of course there will be marks for the computation of these ratios. If you have the correct ratios, then of course there will also be marks for the assessment. Let's start with the acid test ratio. When we look at the acid test ratio, you see you have a 1.07, similar sized is 1.5, industry average is 1.2. Acid test ratio. Now when it comes to the acid test ratio, you'll see that this acid test ratio of the ATL group is lower. It is lower than both the similar sized company and the industry average. What does this indicate? This indicates a potential liquidity problem, as the company may struggle to meet its short-term liabilities with its most liquid assets. Okay, so the company's acid test ratio is lower than both the similar sized, that's 1.5, and the industry average of 1.2. This indicates a potential liquidity problem, as the group may struggle to meet its short-term liabilities with its most liquid assets. What should be the recommendation? Of course, you have to give the recommendation as you're trying to assess. So the group has to focus on improving its working capital management, either by reducing on the short-term liabilities, or they have to increase on their quick assets like cash, receivables. Yeah. So this could involve strict credit control to collect receivables faster, or even negotiating better payment terms with the suppliers. So asset test ratio, it's not good for sure when you try to compare it with a similar size and then the industry average. Interest cover, when it comes to the interest cover, the group's interest cover of 2.69 is slightly better than the similar sized company at 2.5, though lower than the industry average of 3. So the group can currently meet its interest payments. The group can meet its interest payments, but this ratio suggests that it's more vulnerable to a drop in profits than the average company in the industry, because the average is 3 and then this is 2.69. So it's more vulnerable to a drop in profits than the other companies in the industry. What should be the recommendation here? The company has to focus on increasing its operating profits to provide a larger buffer to cover the interest expenses. Of course, that can be achieved through the same measures recommended for improving profitability. How can they increase profitability? We are going to see that. But that is the interest cover. That is the interest. That's the interest cover. It's better than the similar sized, though lower than the industry average. So the group can currently meet its interest payments, but the ratio suggests that it's more vulnerable to a drop in profits than the average company in the industry. So they have to improve on their operating profits to provide a larger buffer to cover the interest expenses. So they have to increase on the profits. When you look at the gearing ratio, return on capital employed, 10.59, 25%, 20%. This is lower. Very, very low. So the group's return on capital employed of 10.6 or 10.59 is significantly lower than its peer. That is the similar sized at 25% and the industry average at 20%. This poor return on capital suggests that the company is not using its assets efficiently to generate profits. What could be the recommendation? They have to analyze their cost structures to identify areas for reduction and improve on their operational efficiency. Okay, so they could explore opportunities to increase their sales revenue or optimize their pricing strategy to boost their profit margins. Otherwise, the return on capital employed is very, very low. Gearing 46.13, 40, and then 50. The gearing ratio is higher than the similar sized company, which is at 40%, though lower than the industry average. So the group is not highly leveraged, and even the industry still, because it's at 50%. So meaning that it's 50-50. More 50-50. This is 46.13. So the group is not highly leveraged as the industry, because the industry is 50%, but ATL group is 46.13%, so it's not highly leveraged as the industry. Then at 40%, similar sized, meaning that this group is more reliant on debt than its direct competitor. So what should they do? This is a financial risk, of course. To reduce this financial risk, the group should consider reducing its reliance on debts by using more equity financing, or even retaining a high proportion of its earnings. That is gearing. So you compute the ratios, then you also give a commentary, where possible suggest some recommendations, then you get the marks. So thank you so much. If you have questions, please feel free, share them in the comment section. I'll answer them. Thank you for watching. Bye bye.